In this section, we're going to be diving into some tax write-offs that could literally change your business and your tax life and save you thousands of dollars every single year when filing your taxes. Welcome, welcome, welcome to the Tax Life. I am your host, Jeffrey White, 30 plus year tax professional, military veteran, financial professional, and I'm living the tax life just like you guys are. Tonight's session is, it's kind of geared toward those of you that have businesses and have gone to gone through the process of setting up your business and creating an LLC for your business. And our topic is about what I consider my top 5 tax write-off for LLC businesses. Okay. Now, yeah, this topic is geared toward LLC businesses, but the information here is actually good for all other types of businesses. Schedule C sole proprietors, LLCs that are partnerships, LLCs that are S corporations, because these top write-offs are dynamic and they are geared to help you position yourself as a business to be successful. Okay. So we want to unlock the power of LLC write-offs. And I've been in business for 13 years now on my own with partnerships, and then now primary owner. And what I realized is that businesses have an advantage over people, taxpayers that don't have businesses, okay, in tax law and tax planning, okay? And the idea is that if you are a business owner and or LLC business owner, you need to know certain things that you are going to have to do and should be doing daily in your tax life. All right. So now, if you are a LLC owner and a business owner, have you ever filed your taxes and thought, man, this just isn't working? Okay. Maybe it seems like everybody else knows something that you don't know. Okay. And that you're missing out on some things in your tax life. And the truth is that many LLC owners, they are missing out on powerful write-offs that can affect their tax life, okay? And that's just simply because no one has ever really taken the time to tell them what's available, okay? So in this section, we're going to be diving into some tax write-offs that could literally change your business and your tax life and save you thousands of dollars every single year when filing your taxes, okay? And these are going to be my 5 top write-offs for LLC businesses, okay? I want to tell you how to use them legally, okay? The IRS is not going to, they don't tell us about these. Yeah, it's there in the IRS code, but we're not taught these in school. We're not taught these in classes. And most tax professionals that are out there, they don't use these write-offs and plant them into their client's head as things that they should be doing on an ongoing basis in their tax life, okay? They don't teach us how to do this and use these laws, okay? But this is where increasing your exposure and your attention to tax laws come into play. And so our goal for this session is, if you're an LLC business owner, and even if you're not a LLC business owner, but just maybe a sole proprietor business owner, but we want to expose you to a deeper understanding of these available laws that are actual write-offs, okay, and how powerful they are, and they're available to you. And if you pay attention and intentionally start to integrate them into our lives, it'll affect your tax life, okay? And if you're ready to stop guessing and start saving, Give me a thumbs up in the comments, okay? Now, let's talk about what are write-offs, okay? And why they matter. So, you hear the word write-offs, and I've been hearing that word for years. I remember as a teenager um, sitting down at our dining room table with my mother's tax preparer. His name was Joe. And uh, I sat down. I sat down at the table for a couple of reasons, right? One, my mother was a single parent, and I didn't know Joe. Okay, so I need to find out who's this man coming and sitting at my dining room table with my mom. But after a couple of years, it was kind of the thing where Joe would come by and they would sit for a few hours and do her taxes. Okay, so I would hear things, and I was always kind of a curious person, and I would hear things, and the word write-offs was one of the things that I heard, and I kind of idea what it was, but I didn't really have a really a good understanding of it until I did my own taxes, um, and figured out that a write-off is just an unofficial way of saying a tax deduction. Okay, a write-off is a tax deduction, and these tax deductions are written into IRS tax code. And what they are, if the IRS will allow you to take a deduction or for an expense, and that's a minus from your income, um, and allows you to lower the taxable profit from your business, which in turn lowers the tax that you pay. Okay. So again, in previous lessons, we have talked about how businesses have advantages that other taxpayers don't have, and how positioning yourself to take advantage of these write-offs are a good thing. But when you have available write-offs and you're able to deduct them directly from your form, your Schedule C, then what they do is they reduce the amount of income, which reduces the amount of profit and reduces the amount of tax that you owe. Okay, and not all deductions though are created equal. Some deductions they are protecting small expenses, and other deductions they unlock massive savings for your LLC. So let's walk through what I believe are my top 5 write-offs for LLCs, and I rank them from I don't want to use the word least important because they're all important, but how about least impactful to most impactful? Okay, and that's based on what is commonly used when you're doing your taxes on an LLC, and then the maximum tax savings potential, and that's how they get their rating. All right. So my number 5 tax write-off for LLCs that I think is powerful, the home office deduction. All right. And if you are in the business and you run an LLC, even if you run that business from your home, even if it's a part-time business, you could be eligible for this write-off. Okay. Now, to qualify for the home office deduction, here's the thing: you must have a dedicated area in your home that you use exclusively and regularly for business purposes. Now, when I first started doing taxes back in the, believe it or not, the 90s, when I first started, I used to think that this was a room, right? A room, right? And for the most part, everybody kind of talked about it as a room. But over time, what I realized is that it doesn't have to be a room. It could just be an area, okay? But the key thing is that that area is used exclusively and regularly for business purposes, okay? And it must be the principal place in your home that the business uses where you do business task or administrative work, all right? So there's 2 methods to claiming the home office deduction. The first one is called the simplified method. And as the word says, it's simple, all right? the IRS gives you a dollar amount, $5 per square foot of the area that you use, and then you can use the area up to 300 square feet. So maximum that you can get on the simplified method on home office deduction is $1,500. Okay. Now the other method is actual expenses. Okay. And actual expense method is a little bit more complex, not too complex, but it's a little bit more complex, but in a lot of cases it's more impactful. Okay. So what you're allowed to do is take a proportionate share of certain expenses related to your home off because you use that area that we talked about exclusively and regularly for business. And what I mean by a proportionate share. So really simple calculation or a really simple explanation of the calculation is you take the total square footage of the area that you're using. So let's say it's 100 square feet, and then you divide that into the total area of your home, and then you're going to get a percentage. You calculate and convert that to a percentage. So let's say your business use of your home or that percentage of that area is 5% of your home. So now you can get 5% of your actual expenses related to your home from the indirect version. So everything related to usage of your home. Okay. Then you can also get a dollar for dollar deduction for things that are expenses that are related to the actual area. Okay. It gets a little bit complex, and that's why you need to have a professional help you with it. But I want to just kind of give you an idea. But anyway, you take that 5%, and now you can write off or deduct 5% of your rent or mortgage, okay? 5% of your utilities, the insurance on your home, or again, it doesn't even have to be a house that you're buying. It could be a house that you're renting or even an apartment. Real estate taxes, repairs and maintenance on the home, and even a depreciation deduction if, in fact, you do own or buying the home. Okay, so you can see how powerful this can get. Okay, and you can see how the actual method, if you really want to punch and get your tax savings, you probably want to use that method over the simplified method. Okay, but each case is different. Now, here's a professional tip. Okay. And I really, really stress this with my tax planning clients, but you want to take pictures of that area. Okay. Now, in my opinion, a room would be better. Okay. But an area is fine. Okay. The bigger the room, up to 300 square foot, obviously, the better. But take pictures because you want to have a digital representation of that area, and also maybe write down the measurements and the dimensions and have a written plan as well, or a written diagram, if you will, for that dedicated workspace. And then that's your proof to the IRS. Okay. And that has actually, I would say, that actually had saved one of my clients that I went to an audit with. It saved them some money on that audit. Okay. So if you're paying rent already or you're paying a mortgage, you might as well let your LLC business help you to get an expense deduction, cover it legally, and save some money on your taxes. All right. So number 4, equipment and technology. All right. Now that's a pretty broad area, and it actually covers multiple areas of the expenses on a profit and loss statement or on the Schedule C, but we'll talk about them together because they are all part of the power of write-offs on your LLC. So if you're a content creator, let's say, or you are a IT consultant, or maybe even a home contractor, you work on homes and fix homes, right? The tools of your trade, the things that you use to do what you do, are deductible items or write-offs. Okay. So let's talk about some examples of things that you can write off. Okay. Computers, printers, cameras, okay, cell phones, okay, even your cell phone service, okay. You can write off things that are software related, like applications that you have on your phone that you use in your business, okay, subscriptions that you might have, like Zoom or Google Meets or Canva, um, and obviously machinery or other types of equipment. Obviously, if I have a tax planning client that um, has a t-shirt business and they do silk screening, and their machinery is a deductible item that we're using every year to create um, we're using it to create deductions that lower their amount that they're going to be taxed on their profit. Okay, but this machinery and other equipment that you use in operation of business, they have major abilities to write off and get deductions for them. Okay, there is a deduction in an IRS code section 179 that lets you write off the full cost of equipment upfront totally. It is really an accelerated expense deduction versus having to take a deduction over many years. Okay, 5 years or 10 years or 15 years for a piece of equipment. Whereas this particular write-off, if you will, allows you to take the full amount of that purchase for machinery or equipment. Okay, there is another tax write-off, a deduction, a law, IRS Code 168 allows that will allow you to take bonus depreciation. Over the last few years, bonus depreciation has gone down. At one point in time, it was 100%, just like Section 179 deduction. Then it went down to 80%. Then it went down to 60%. And it is scheduled to sunset out. But the current administration is looking at bringing back bonus depreciation back up to 100%. And what that does, honestly, is, again, we talked about how the IRS likes to incentivize our behavior. And if you're an LLC owner and a business owner, when you can pay for an item one year and then the next year get that deduction, then that conceivably, it puts cash back into the business. And then the hope that the government is relying upon is that saving that money is going to change your behavior, and you're going to want to invest back into the business. That business grows, it starts to employ people, and so on and so on and so on. Okay. Now, number 3, vehicle expenses. Okay. Are you using your car for business? If so, that business mileage could be worth thousands of hundreds or thousands of dollars in deductions. Okay. And the first thing that I want to talk about is you have to keep really good records. And we'll get into that a little later. But 2 ways to qualify for and use vehicle expenses and get write-offs or deductions for them. Okay. First way is the standard mileage method. Real simple. Every year, let's say periodically. Okay, not necessarily every year, but periodically, the government will make an assignment of a dollar amount that they will give to business owners, LLC owners, in mileage that they use their car. Okay, so you use your car in business, and every year there's a mileage or dollar amount attached to every mile that you drive. Currently, it was 67 cents per mile in 2024. Okay, now simple calculation. 67 cents times the number of miles you drove, bam, you put that on the Schedule C, okay, and get that dollar 67 cents, if you will, per mile off of your income, okay, your taxable income, your profit. So now the second method is the actual expense method. This goes a little deeper, okay, and it's almost like the difference between tax preparation and tax planning. But this method will allow you to take the value of the vehicle that you're using, okay, and it doesn't have to be a vehicle that is bought by the LLC, but it could be the value of the vehicle that you're using, and that value will now allow you to take a deduction for depreciation over a certain period of time. And in previous years, you could use the accelerated depreciation method, depending on your car. You could use the bonus depreciation, but it allows you to take the value of that car and start to create deductions from that car up to the business proportion, up to the proportion that you use that car in your business, okay? But you can also take things like gasoline, okay? When I say gasoline, what you pay for gas, maintenance and repairs on the car, insurance to the car, for the car, even lease payments. But keep in mind, it's at the percentage in which you use the car. So obviously, if you use the car 30% of the time, then you could take 30% of the gasoline that you use for the car, and 30% of the maintenance for the car. These are actual expenses that you actually incur that the government is going to allow you to deduct or write off of the income that you make, which is going to, yeah, it's going to reduce the profit, but it's also going to reduce the tax bill that you have when it's all accounted for. Okay, so that's a really, really powerful deduction because it takes depreciation, which is really super, and also the actual expenses that are actually paid, and puts them together to create the vehicle expense. Okay, professional tip: um, write the miles down. Okay, now just like I've had clients in audits get a good review, if you will, for keeping good miles. I've also had a client that did not get a good review, and that was because of the lack of a mileage log. All right, and it goes back to tracking. It goes back to um, doing good paperwork. It goes back to being tenacious in your tax life and putting a process and system together. But anyway, you can keep a written log, okay? And this is what I did for many years. But I also didn't keep a log for years as well. Okay, let's just keep it real, right? But I mean, you live and you learn, and you know better, and you want to do better. So, but right now I use an app called MyIQ, and I like the digital way of keeping a log versus the written way of keeping a log. But both will do, and the IRS is even will even allow you to recreate a mileage log. Let's say if your mileage log was lost, or there was a certain span of time that went between the time that you created a log and you maybe had gotten to an audit situation. But the log is going to be paramount if you're ever audited to proving, one, that you use that car for business, and then also the percentage that you use that car for as well. And then even if you want to calculate and take the standard mileage deduction, then it's also important because that shows the mileage, and then it just helps you to know the mileage so that you can um, calculate the right deduction amount. Okay. But if you're gonna be driving anyway, and you got a side gig or a part-time business, or even this is your full-time business, you're gonna be driving anyway. Proper mileage tracking um, allows you to track and get every business mile driven becomes a money-saving opportunity for you. Okay. All right. Number two, the Augusta Rule. Okay. Now, the Augusta Rule is IRS code. You'll find the IRS code 280AG. Okay. And this is a gem for business owners, okay, because it's so powerful. Okay. It can get a little complex. There are definitely some things you have to do to make sure you are compliant, but it's powerful. Okay. So what is the Augusta Rule, right? The Augusta Rule allows you to rent your personal home to your business LLC for up to 14 days per year. tax free. Okay, when I first heard about this rule, when I started making my exposure and my attention to tax planning greater, I was like, man, this is like wow, this is this is like wow. Again, it's still wild to me, but the Augusta Rule came into to play in the 70s, okay, and it was named, and that, I don't think that's the official name for the, but that's what it's called, unofficially, like, um, but it was named after Augusta, Georgia, okay, and Augusta, Georgia is the home of the Masters golf tournament, the green jacket they wear, Tiger Woods and everything like that, um, and it came about because Augusta, Georgia is a small southern town, and there were lots and lots and lots of tourists that would come to Augusta to go to the tournament. And the tournament's not like a 1 day thing. I think it's maybe 4 days. Uh, yeah, 3 or 4 days for sure. And people would stay there, but it would be hard to get rooms because it's a small town. So what happened was the residents started renting their homes to the tourists, okay? And they still do that today. I have clients that a lot of clients from Augusta, and I have clients that still to this day will leave their home in Augusta for a week, maybe sometimes even longer, rent it out, Airbnb, verbal, or even just rent it out themselves, and utilize this tax law. Okay, but the way it works is you charge, you the person charge your business LLC fair market value for the renting of your home. Okay, this is where having some intimate knowledge and doing some research, this is where a tax professional will come in. But to use this rule, yeah, you're going to rent your home for fair market value to your LLC for business meetings and retreats and team events, and even uh, um, different things that you want to do from the business perspective, and you rent your personal home to your business. Okay, and then your business now has an expense, and they can deduct that off their taxes. Okay, and then you the person now have income, but here's the cool thing: you don't have to report that income on your taxes. Okay, you don't have to claim it. It's tax free. All right. So let me give an example. All right. Say you do a search and you find out that the fair market rental value of your home, okay, is, I don't know, $500 per day, right? And in this Augusta rule, you have up to 14 days to use it. Okay, so if you take the $500, multiply it times 14 days, you get $7,000, and you personally, as the homeowner, now have $7,000 of free income to you, and then it's also a full $7,000 deduction for your business. Okay, and again, I would say consult um, a tax professional that is well versed in utilizing this write off, but it's super. Okay, and this is where I view the difference between a mom and pop kind of tax service, tax preparation situation versus a tax planning. This is something that should be integrated in a tax plan. Okay, this is a tax free strategy hiding in plain sight. Okay, all right, here we go. My number one, marketing and advertising. Okay, marketing and advertising. I put this as number one. Um, it's just, I believe it's the most impactful and has a lot of long term benefits. Okay, now think about this. Okay, I'm gonna tell you a story. Right, years ago, in the 2000s. I can't even remember. I'm not really good at remembering years. I know some people. I mean, they know the day, the time, the hour. Okay, and they'll tell you that story, and it'll be all that. I don't remember. But years ago, when I was living in Los Angeles. Okay. Um, I started my own tax firm, right? And it was partly out of necessity because I had lost a job and I was in between jobs. And I remembered that, hey, I had the skill of tax preparation, right? I was doing tax preparation and a little financial um, advising at the same time. But anyway, I said, okay, let me go out and I always had the entrepreneurial dream. So yeah, let me go out and do this thing, right? So at the time, I lived on a major street in LA, okay? And down the street from where I lived was an office park, an office building, right? And it had individual offices for rent. So I went in there and um, I rented a space, right? Now, again, I was young and, just kind of getting it was my first real official business. Um, and what happened was I went there, I rented the space, it was upstairs. It wasn't a retail setting where people could just walk in from the street. You had to walk in. If you didn't know that I set that business up, then you wouldn't know I was there. And that's the point I'm trying to make is, okay, the, nobody knew I was there, okay? And I had um, no plan, no campaign, no real marketing or advertising that was being done other than word of mouth and business cards. And so your business needs to be seen, and my business needed to be seen. It wasn't long before um, I shut the doors and took on my next career, but it was a lesson that I learned. I don't say the hard way because it ended up being a positive lesson when I finally did get another business. But the lesson that I learned was if nobody knows you there and you don't market and you don't advertise, yeah, you got a business on paper, okay, at the local government, LLC at the state level, IRS. But if nobody knows you there, then you don't really have a business. And your business needs to be seen. And that's where marketing and advertising come in, right? And when you invest in the visibility of your business, the IRS rewards you. Okay. So marketing and advertising expenses are deductible, dollar for dollar. Okay. So think about this. You got things like social media advertising. You can advertise on Facebook, you can advertise on YouTube, you can advertise on Instagram, okay? You create business cards. These are all expenses for marketing and advertising that you should incur, okay? Creating logos, websites, copywriting maybe sometimes, um, helping you with maybe a blog or something like that. But these are things that increase your invisibility, okay? Maybe you sponsor an event. I was just talking to one of my clients about sponsoring my first live event soon, okay? And when we sponsor it, when we put it on, whatever costs we incur, we'll be able to write that off, okay? Emails, your Gmail, whatever things that you pay for, even print material you might pass out or create for distribution. These are all things related to marketing and advertising, and they're all write-offs dollar for dollar, okay? So the reason why I gave this thing my number one vote is because it hits you, it hits your LLC business in two ways. It's powerful, okay? Um, well, one of the ways that it hits you is that you get deductions, dollar for dollar deductions, okay? You spend $1,000, you get $1,000 write-off or deduction, all right? Here's the other thing, though. It's not like a piece of equipment which is needed in the operation, okay? It just, that piece of equipment doesn't necessarily help you grow your business. It just helps you operate and produce something. Here's the thing about marketing and advertising. It helps your business grow, okay? If when I first started that first business, and it was a tax and financial services business, if I would have had a marketing plan together, if I'd have had money to market, but if I would have had a marketing plan together and marketed and advertised and social media wasn't even around then. But the idea was, if I would have had money to spend on marketing and advertising, I would have gotten a write off of it, but it also would have increased my visibility, which would increase people coming in the door, knowing where I was in that office on the second floor in the back. Okay, not visible to the street. Okay, lessons learned, right? So you get a twofer in that particular write-off, because you get a deduction, but you also, it's going to help your business grow. Marketing and advertising help your business grow, increase your availability, and increases the amount of people that know you're in business to begin with, and then that in turn should increase your availability to make an offer to people that know you're in business. Okay, that's when you have a real business, and that's why I like this particular write-off as my number one. It can be an expense as well as a driver for business growth, which increases your income. Okay, so that's why I like that one. Plus, it's repeatable. You can do it over and over and over again. Um, there's no limitations on how much you can spend on advertising and marketing, and then it helps you to grow your business either vertically or horizontally. But that's why I like it. Okay, deductible, but it also drives growth. All right. Great marketing should always be seen first as an investment in your business, and then as a bonus, it can be an expense. Okay, which again lowers your taxable income, which lowers your tax, which lowers what you pay, which means you can save. Okay, and the IRS really wants you to be successful. That's why they incentivize our business behavior um, through the tax law. Okay, now for this session's immutable law. Okay, um, again, mutable laws are principles that do not change. And that's basically what the word immutable means. It's not going to change. It is what it is. Okay. Anyway, this week's law, this session's law, is the law of alignment. Okay. And we've talked about this law before, but again, um, we're talking about a change of mindset. We're talking about moving in the direction. We're talking about it not, it's, not, you're not gonna learn these things. You're not gonna put them into practice overnight. So we're gonna be repeating things. The law of alignment. Let me read what it says. It says, when thoughts and actions are in harmony, results follow. All right. You may want to write this down. When thoughts and actions are in harmony or alignment, results follow. Okay. So when your LLC, when its operations are in alignment with tax strategies, okay, or the top 5 write-offs, right? When they all move in the same directions, you can create unstoppable, great momentum. And momentum is a force, and we want to always be moving forward, okay, especially in business or in our tax life, all right? So too many entrepreneurs, they they focus on what they really focus on first is operations. Okay. Now I found this out in my 30 plus years. A lot of people have a lot of dreams related to being an entrepreneur and being self-employed. Okay. And a lot of people are good at what they do, whether it's full-time or side part-time, right? What I've found out is that their focus is on the operation and bringing in money to the business, okay? And they ignore the other sides of business, okay? Business is not just doing the thing that you're good at, okay? You're operating, yeah, that's a fact, okay? If you're a lawn care person and you're out there riding that lawn mower and you're doing your thing and you're spinning and doing all that and you get the grass all up and boom, boom, boom. Yeah, that's good, right? and you focus on getting that money, getting paid. But what I found out is that a lot of entrepreneurs and business owners, they focus on operations and revenue, and they ignore the back office stuff. They ignore the administration stuff. They ignore the paperwork, and then they ignore positioning their business to create savings in their tax life. Okay, when your income model aligns with your tax model, it's gonna potentially save you much more money, and it's gonna become it could become exponential. Okay, the savings that you get. Okay, um, there's a thing called the snowball effect. Okay, and you know, may start off small, but as momentum grows, I mean, I don't think this is true because I think I saw something that says not really true. But anyway, the idea is that as a snowball rolls downhill, it starts to accumulate more snow, becomes bigger and bigger. We all seen this on cartoons, and one of our cartoon characters get run over, flattened or whatever by the snowball. But the snowball effect is really more about momentum and moving forward. And in business, the goal should not be only to make money, not just to make money, but it's to make money, and then by by strategy and tactics, saving more and keeping more legally, ethically, and strategically. Okay. Um, One of the things I learned early on, I believe it was my mom that said this to me. I'm sure she heard it from somebody else, but she said a lot of times it's not what you make, it's what you keep. Okay. And I'm all for making a lot of money. Okay. But I'm also for paying your fair share of your taxes and using the tax laws that are there for you if you're an LLC business owner or just a business owner, and using them to your advantage to save money so that you can invest back in your business or invest in yourself and live your dream. So let me review my top five. And again, these are my top five. And other tax professionals may have their own their own top five, but these are my top five. Okay, and in reverse order: home office deduction. Okay, technology and equipment. Okay, we're gonna have the vehicle expense. Okay, our vehicle expenses. All right, the Augusta Rule, and marketing and advertising. Okay, and again, that's from the bottom to the top. But again, when you look at a Schedule C, right, or when you look at 1120 S corporate return, right, when you look at the number of write-offs or deductions that are available to you as a business LLC or other types, it is great. Okay, and you have to position yourself to take advantage of these. Okay, and these write-offs, they're laws. They're not tricks. They're not hocus pocus. They're tools. Okay, and if you're not using them, okay, or if your tax preparer is not using them, or if you are maybe using them but you're not documenting them properly, okay, you're paying the price, or you putting yourself in the position to pay the price if you don't document things properly. Okay. Tax code favors activity, not passivity. All right. And it rewards tracking and not guessing. And if you are ready and you want to stop guessing and start planning, here's a few things that you need to do. Okay. You need to write down, if you're an LLC owner in particular or a business owner, you need to write down 5 deductions that you're not using, which means you may have to look at how your business operates and identify them. Okay. You need to build a habit of tracking and integrating things that are in your personal life with your business life. And a tax professional that is well versed in planning should be able to show you how that works. The appointment that I had with my client the other day, we were talking about that very thing, about integrating some of the personal things in your life with business in your tax life. And the idea is that when you know how to integrate and to leverage some of the things that you're already doing personally into business, man, things just really explode. But it's not for the weak of heart, and it's not for those that are guessing, but there are those for those that are planning. And you can plan for things in a lot of cases that you don't even realize, but it has to be thought through, and it has to be discussed, and it has to be researched. Okay, and that's where the right tax professional and the right plan comes into play. All right, so final words. Deductions equal leverage. Okay, leverage just helps you to do things easier. Okay, and increases your performance and increases your power. Okay, leverage, and each deduction is available for you, and it reduces your taxable income. Okay, remember the principle of the law of alignment. Okay, smart businesses, they align their revenue model, their business model, with strategies that help them to build their tax life. Okay, and then finally, I want you to start now. These lessons, these sessions have awakened you. That's what they're designed to do. My ability to affect as many people as I can in their tax life, and even somewhat in their personal life, that's my purpose moving forward. So I wanted to say thanks for listening. Thanks for watching. I appreciate the opportunity. And as usual, I want to ask you, what's your dream?